I now hand the conference over to Mr. Srinivasan Vaidyanathan, Chief Financial Officer, HDFC Bank. Thank you, and over to you, Mr. Vaidyanathan.
Okay, thank you, Neerav. Good evening and a warm welcome to all the participants. Briefly, we will discuss the bank performance, and before that, perhaps I provide a broad context on the environment. The underlying economic conditions continues to remain healthy. We do expect that the higher levels of consumption and rural demand recovery will push the overall economic growth to be about the 6.7% in the second half compared to the 6% in the first half. And similarly, we do expect that the CPI inflation that came in recently at 5.2 will get below the 5% level and head to the 4.6% by March, providing a conducive environment for private consumption to pick up, which we expect would be in the second half around the 7.8%, and the government consumption growth is also pegged by our house view at about 6.1%. Now, we have seen that the manufacturing PMI remains strong in the expansionary zone, and the services PMI also above 60 continues to be in the expansionary zone. And we do need to watch out for the external challenges, unevenness in private capex. Some of those factors pose risk which need to be closely watched. Now, getting to the bank's numbers in the quarter that you have seen, the advances under management at 26.8 trillion rupees grew 6.1% over prior year, and on an average AUM basis grew 1.86 trillion rupees, 7.6% versus prior year. On the deposits front, the total deposits reported rupees 25.6 trillion grew year on year by 15.8%. On an average basis, also it grew 15.9%, 3.36 trillion rupees. Sequential quarter, on an average basis, we grew close to 1 trillion, 0.99 trillion or 4.2% growth, and powered enormously by the time deposit, which grew year on year by quarter on quarter by 0.9 trillion on an average, 5.8% growth. That's in terms of the headline volumes. On the distribution expansion, we grew 51 branches in the quarter and 1,052 branches in the last 12 months. And this year in 9 months, about 405 branches or so. So we continue to expand our points of presence. On the payment acceptance points, we have 5.4 million, a growth of about 12% since last year. On the customer franchise addition, we added 1.9 million new liability relationships in the quarter. Our customer base stands little above 96 million, 96.7 million customers. We also added 1.5 million cards during the quarter. The total card base stands at about 23 million. We have a strong balance sheet with a total capital adequacy ratio at 20%, CET1 ratio at 17.3%, so 17.5%, and the LCR quite strongly positioned at 125%. Now, getting to the revenues. Revenues for the quarter at 421 billion grew 6.3% over prior year. Net interest income at 307 billion, which is 73% of the net revenues, grew 7.7% over prior year. The core net interest margin was at 3.43%, and the core net interest margin on an interest earning asset basis is 3.62%. Now, getting to the other income, aggregating to about rupees 115 billion, within that it comprises the fee and commission income, which is 71% of the total other income, at about 82 billion rupees, grew 17.9%. Similarly, the foreign exchange earnings and derivatives income at 14 billion grew 16.5% over prior year. Now, getting to the expenses, expenses for the quarter at rupees 171 billion increased to 7.2% over prior year, and cost to income ratio was at 40.6%. Now, getting to asset quality, the GNPA ratio was at 1.42% compared to 1.36% in prior quarter, This includes the impact of the agricultural segment, which is seasonal between the Rabi and the Kharif crop season, so the December season gets impacted. So GNPA, excluding the agricultural segment, at 1.19%, remained flat to what it was in the prior quarter at 1.19%. Now getting to the slippage ratio, the slippage ratio in the current quarter at about 35 basis points compares to 88 billion rupees or so, and it's excluding the impact of agri at 26 basis points is flat to prior quarter. Now getting to the total provisions for the quarter at rupees 32 billion compares to 42 billion in prior year or 27 billion in prior quarter. Again, impact of the agri. Excluding agri, the credit costs have been fairly flat quarter to quarter. You know that we do have floating general and contingent provisions, which account for almost 169% of gross non-performing loans. And on a basis point basis, floating contingent general provisions are about 1.43% of gross advances as of quarter end. Now getting to profit after tax at 167 billion, grew on a reported basis 2.2%. But as you know, last year we did have tax adjustments and treasury items and net mark-to-market trading gains. Excluding those one-offs, the profit after tax grew by 13.6% versus prior year. Now, getting to in summary, the results reflect robustness in various parameters, passionately driven by our employees. We are progressing in our journey to normalize the CD ratio with the deposit growth outpacing the loan growth, which I just described above. We have seen robust growth in our average deposits close to 16% year on year, and the AUM growth close to 8% year on year. We have delivered the strong deposit growth despite the challenging macro environment, which again, system liquidity being neutral to negative through the quarter. NIM remains in a very range bound with an upward bias. OPEX continues to be managed very tight at cost to income ratio at about 40.6%, as despite our franchise continues to demonstrate strong deposit growth, which OPEX growth of 7%, deposit growth of 16%. Credit parameters continues to be pretty stable, and we are robustly positioned, growing in a very balanced manner, and get the strategic imperative to rein in our CD ratio. We have sufficient liquidity as well as capital and continue to grow our deposits, allowing us to be in a comfortable position to grow and capture market share in advances when the macro turns favorable. So with that, maybe I stop here and open it up for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Please note, participants are requested to restrict to 2 questions per participant. Kindly join the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi, sir. The first question is with regard to the net interest margin front. If you can explain at what point in time this contraction is likely to end, considering specifically that there is going to be a rate cut, or is the expectation of a rate cut is very high at this point. And the second question to that is also, while I understand agri slippages have added to the NPA for this quarter, CRB slight 1 basis point is a very small number, but on the base it looks larger. So just want to get a sense as to where those slippages are coming from.
Okay. Two aspects of it. One on the margin. See, one thing on the margin is that it has been fairly stable compared to various industry players that you have seen or you will see, which is how, because of the positioning, the duration, the modified duration of the assets and the modified duration of liabilities are fairly matched, very closely, tightly together. There is an impact on the rate, right? When the rate does change, there is a lead and a lag effect, but then that is a quarter-to-quarter effect, not an annual effect, because they stabilize over a period of a year. So that's one on the margin as such. Otherwise, we are positioned in a way that CASA, hopefully, as you alluded to, when the rate changes, the preference of customers today has been more towards time deposit, wanting to lock in little higher yields. We should see that, which is what we have seen over the last 2 or 3 large cycles over 10 years. We've seen the customer preference also moves into the CASA area, and that also provides a tailwind there. So that's one on the margin, right? So we'll have to wait, and both customer preference plays out, as well as not quarter to quarter, but over a period of an annual year, if you see that the bias is to be stable to moving up. Now, the second aspect of it you touched upon on the NPA as such. On the NPA, what needs to be seen is that the overall NPA at 1.42, excluding Agri 1.19, it's flat quarter to quarter. It's been pretty stable between that. And then the next other important thing is to look at the slippages, how accounts slip into non-performing. That also, if you look at it excluding Agri, because you know that in December and June, you get that impact of the seasonal, the crop season impact that you get. But excluding that, it is flat, 1.02 to 1.02, both sides. And similarly, on the credit cost also, when you look at the total credit cost at 50 basis points, or net of recoveries 36 basis points, it is pretty flat excluding Agri. It's either 42 or 36, whichever way you look at it, excluding Agri, it is also flat. So it's a function of the seasonality of Agri that will have to play out, which has played out. Other than that, every other portfolio groupings that we have, the retail book or the CRB book excluding Agri, or the non-retail book, all of them are the corporate wholesale book, all of them are pretty stable over this time period. And you alluded to a basis point or 2 on CRB. Yeah, 1 to 2 basis points can always move at any point in time. Those are normal in terms of how things happen. And again, how many festival days were there and how many working days. I don't want to go into those kind of minutiae. There are several factors that go, but a basis point or 2 left, right, that doesn't change the fundamental construct of the quality of the book that continues to be pretty strong.
Sorry, just if you allow me a follow-up around the margin question. Now, your advances get repriced faster than your deposits. So while I understand the customer preference will change, but in the short term, will there likely be any changes?
Quarter to quarter it will be, but I would urge you not to look at quarterly, because that's not how we manage. We have to manage it over a period of at least annual and longer. And so that is how the book is positioned, not for quarterly changes, but for how do you manage it over a year.
All right, sir. Thank you. I'll come back.
Thank you. Thanks.
Thank you. Next question is from the line of Piyush Shukla from Hindu Business Line. Please go ahead.
Good evening, sir. Am I audible?
Yes, please. Good evening.
Yes, sir. Sir, OPEX is a little bit higher as we are continuously investing in building a retail franchise. Want to get some guidance for the current year as to how many branches will you add? What would be the impact on your OPEX because of that? How much will it rise? And secondly, sir, you alluded towards higher seasonality impact in this asset quality, particularly in agri loans. Going ahead in the current year, if you could give a broader assessment as to how these last year unsecured segment was a bit under pressure, MFI segment, unsecured personal loans, so on and so forth. So at HDFC Bank, how do you see the asset quality panning out in the current calendar year, and in general also in industry, what are the trends that you're seeing, sir? Thank you.
Yeah. More than giving you an outlook of looking forward, I will tell you where it stands. That gives you the level of comfort, how we manage and where we are positioned, both on the cost as well as on the credit. Getting to the cost first, expenses first, right? For the quarter, 171 billion rupees. Cost to income ratio 40.6, stable one period to another period. and the rate of growth year on year is 7.2%, or quarter to quarter 1.3% change, right? Which we believe that is one of the levers that is strongly positioned expenses. And more important on expenses is also if you look at cost to assets at 1.93 thereabouts is one of the best in class in the industry. If you compare us to any of the private sector or the industry average, at 1.93 or thereabouts on the cost to assets, expenses by assets, is one of the best in class. So highly efficient. And you touched upon the investments in branches. Yes, we do make investments in branches to expand our distribution reach, because that's the fundamental tenets of how we acquire and engage with customers to manage them for better relationship. And as we grew 51 in this quarter, 405 this year, there is no one particular target or outlook that we have provided, right? The last year we grew close to 1,000 branches. This year so far 405 branches. Where we will end, we will not get a particular outlook, but then our trajectory is to make certain investments to reach. But it is not for eternity, in the sense that we evaluate it periodically in terms of how many we need, and then you take a pause to drive the productivity of those, so that both the employee productivity as well as the engagement with the customers, the reach to the customers happen. And one other important aspect of all of this is once you get those branches and people and get the reach, you need to get on with customers. So we have added 1.9 million customers in the quarter. Similarly, last quarter was about 2 million or thereabouts. And last year, whole of last year, we added 9 million customers or so. So we keep bringing on. Now we have about 96.7 million customers to work with to deepen the relationship. So that is how you perceive. So there is no one particular number, but that's part of how we manage. And we do see that the density of branches in the country is the level of what you will see in a Western market. So we do see that the country does need more distribution presence points to be closer to the customer for better engagement. So that's one. Without any particular number of an outlook, I just gave the fundamental tenet of how we operate on that. The second aspect of it that you asked about is the quality. Yes, I alluded to say that other than the seasonal agri, the overall portfolio is pretty strongly positioned, both from a GNPA point of view, the leading slippage also remaining flat, and thereby the credit cost also remaining flat from last quarter to this quarter, if you see, have been stable. Then you alluded to see that like last year, the unsecured or the MFI and so on, those kind of portfolios, we are the leading players. We are one of the largest, or I would say arguably the largest market share in the unsecured book between cards and personal loans and so on. Those books are all pretty stable and very strong at an aggregate level. And we do have that SLI MFI, but they are a small portfolio in the overall scheme. But including that, you can see that there is no particular change or blip in any of the NPA numbers or credit cost numbers, because the way we approach it is with the financial education preceding any lending, and we have more than 10,000 people handholding and working with these kind of customers. You know that our SLI book is 100% women folk. That means in the rural, it is given to women for production. That means various products they produce, right? That's the target at which we operate, and they are closely coordinated to ensure that the outcome is perfect. And that is how what was important in terms of giving back to society through these social initiatives. We continue to do this operation and successfully manage the credit quality there. Thank you, sir. I'll come back. Thank you so much.
Thank you very much.
Thank you.
A request to all the participants, kindly restrict to 2 questions per participant and join the queue for a follow-up question. Next question is from the line of Siddhi Naik from Thomson Reuters. Please go ahead.
Hi, sir. I have a couple of questions. Am I audible?
Yes, good evening. Audible, yes.
Hi, good evening. So my first question is on your slippages aspect. Excluding agri, I guess slippages are at around 65 billion. If you could also give me a breakup of how much of it has come from MFI, credit card, and PL. If you could provide that breakup, please.
No, we don't provide that, but we annually publish in our US filing. You will see certain numbers there. But on a quarter-to-quarter, we don't. But all I will tell you is that at an aggregate level, you've seen that 64, which is stable. And that includes all of those books. That includes the unsecured book as well as the credit card book and the SLI MFI book, all of them. And they're pretty stable.
Okay. Next, your wholesale retail mix, I was seeing it's at around 58-42% currently. Where are you seeing this book? Because on a year-on-year basis, also corporate loans have kind of degrown sharply, and QOQ also there hasn't been much of a growth. So wanted to understand from you, what is the outlook are you seeing on your wholesale retail mix? If you could provide that. And my second question is on your HDB listing, sir. If you could give any side of clarification on when are you expecting HDB to list on exchanges, because I know September 2025 is a regulator's deadline.
Okay. Two aspects. One, the retail wholesale mix is about 58-42 right now. Again, the bias is towards the retail because that's where a lot of investments have gone. The granularity of the book and what our credit lies in the retail book, but within reason, right? There are seasonality, and you know that in the last 1 to 2 years, we've been far more tighter on the retail. In fact, we gotten far tighter than what the industry was doing. And at an appropriate time, that is why I said we are positioned well with the liquidity and capital. And as the macro turns, we are there in terms of the lending as such. So the bias is towards the retail, both mortgages and the retail non-mortgages is for that to grow. And that's where our market share leadership is also in those kind of products and lines. Wholesale is important, and it is an important feeder to our CRB, and it is an important feeder to our salary account relationships in the retail. We nurture and develop them, but as you know that it is extremely price sensitive, which means the pricing on the non-retail loans are very tight. The spreads are very tight, and also these kind of professionally managed institutions have alternatives. They go to the commercial paper market, they go to the bond market, and bank is one of the sources through which they fund. And so the spreads have been pretty tight there, but we are there to keep the share going and keep that relationship growing. So we are there on that. So in summary of that, the bias is more towards the retail because the opportunity space, the credit penetration being very low, provides that opportunity there. And for the wholesalers, they have several other alternatives to tap into. The second aspect you touched upon is the HDB. I can't give one particular timeline, but yes, you know that the regulatory deadline is the 30th September 2025. That's the regulatory deadline. In order to proceed with that, we've already made that filing in October. The DRHP is already filed and it's receiving its review at the SEBI. And as soon as we get the approval, we will be in a position to get to the next step of that. So I can't promise one particular time because it depends on various regulatory approvals to be received.
Thank you. Siddhi, sorry to interrupt you. Can I request to come back for a follow-up question?
Sure. Thanks.
Thank you. Next question is from the line of Shipra Pedkar from Informers Media. Please go ahead.
Hi, sir. Am I audible?
Shipra, you're not audible. Can you speak a little louder, please?
Hi, sir. Am I audible?
Yes, go ahead.
Much better. Good evening.
Good evening, sir. So just a couple of questions. Just wanted to understand if you will be tapping the bond market anytime soon, because there were reports that you might come out with an infra bond sometime. You were supposed to come out with an infra bond, but you didn't. So any update on that?
Okay, it's a good question. See, the way it operates is that our treasury, time to time, every month, every other week, evaluates various funding choices to be made, and at an appropriate time we will do. But there is no predetermined action, nor there is a balance sheet driven requirement to do. It is opportunistically at any time we will be there to do.
And any plans for capital raising in the next financial year maybe?
Okay, so good point. Again, we evaluate this every quarter. Currently, we are capitalized. Our total capital ratio is 20%, and our CET1 capital ratio is 17.5%. They're all far higher. I won't say exactly 2x mandatory requirement, but almost that, right? The total capital requirement is 11.7%. We are at a 20% capital ratio. So we are strongly capitalized from that sense. And so I will not be able to give you a categorical outlook of whether we go to the market or not. All I will point to is that we are extremely strong in terms of capital ratios.
Thank you, Shipra. May I request to come back for a follow-up question, please?
Okay.
Thank you. Next question is from the line of Joel Rebello from Economics Times. Please go ahead.
Good evening, sir. Am I audible?
Good evening. It is echoing, but yes, audible. It's echoing. Yeah.
Thank you. Sorry. I just wanted to check. I am a little confused as to why HDB Financial's profits were down this year, year on year. I see the asset quality is approximately the same. The loan book is actually higher. So can you just give us some details on why the profits came down year on year? December this year versus last year?
Okay. See, if you look at the year on this year December quarter to last year December quarter, yes. One of the important line item that changed is the higher levels of provision. So there have been certain management overlays that have happened in terms of the provisioning. And second, from the NPA point of view, the stage 3 NPA for HDB moved from 2.1 in September to 2.25 stage 3 in December quarter.
Okay.
And the stage 3, excluding what we call the sticky, which is items that went past the NPA but came below the NPA threshold, not all the way to zero yet, because they're progressing but not fully progressed towards being zero to 3. Excluding that, the NPA is up by about 5 basis points, right? So which is within a shaking range. And more important is the stage 2 assets, which means assets that are not into NPA, the bucket before the NPA bucket. That stage is showing a good deal of improvement from September to December, which means the pipeline of the flow is improving. Items that moved into NPA, they are coming back. They have not come back all the way to zero. So there's some stickiness there, which we hope to resolve in this quarter. And so at an aggregate level, we see the provisions. The provisions increase between same time last year and this year, including the managed overlays.
Can you give me the numbers of the provision? What is it this year versus last year, including management, if you will give us a breakup?
I think it is published by HDB. It is there in the public. They have published the numbers. I gave you the
on their website. Okay, I'll check that. Thank you so much. All the best.
Thank you. Next question from the line of Ashish Agarche from Pet Trust of India. Please go ahead.
Thank you so much, sir. Hope I'm audible.
Yes, good evening.
Sir, good evening. Small one, you said that the CD ratio is normalizing. So, sir, any targets on this, probably as we head into a new fiscal year, at what level will it stabilize? And linked to it, how much of loan sales will we be really seeing, sir?
Okay, two aspects you asked, CD and the loan sales, two things you asked. On the CD ratio, we are at about 98% or so. Again, last quarter, the quarter before, in this forum and other forums that we have talked about, we have been endeavoring to get the CD ratio to the pre-merger level, which is below 90% mark. Okay. Traditionally, the bank has operated between 85 and 90% CD ratio. So we want to get to that level. In the scenario about a year ago, we always thought that we will get to that level in 3 to 5 years, 4 to 5 years, we will get there. But as we evolved and as we found what was happening in the market, overall credit growth in the market, which was coming down, we took that opportunity to say, let's also accelerate the reduction in the loan growth. There's no change in our deposit growth, right? The deposit continues to pump as much as we could by engaging with the customers to get it. It is all about the credit in terms of how we moderate the rate of growth. So what we had articulated last time around was that this financial year we will be growing lower than what the system is growing. Next year we will grow in line with the system, which is FY26, and FY27 we will grow higher than the system, thereby capturing the market share that we were used to capturing in the past. So that's the kind of a trajectory. So you'll have to give us at least another couple of years before you see that the CD ratio gets back to the pre-merger level also. So that's one. The second aspect of the question you asked is about the sale, so on. Yes, during the quarter, we did have about 20,000 crores or thereabouts, so aggregate 9 months about 10 crores in various transactions. Now, this is a strategic initiative. I think I discussed this last time to you or to your colleague, is that this is the beginning. In 2-3 years' time, we will endeavor to scale this up even further. As the credit growth moves up, our interest is to participate in the credit growth, engage with the customer, get the customer relationship, and not necessarily keep it on the balance sheet. There's no need to be sitting with an asset on the balance sheet. We want a customer relationship. That is of the primary need because of various cross-sell products that we want to be in with the customer. And so this is the beginning that we have done. It's in an experimentation stage in the lab. And as it succeeds and as we start this and grow, get more investors on the table, the scaling of that can happen. But currently, it's at a modest level.
Okay, sir. And sir, second question. Sir, how much of the loan growth softening would be due to issues on asset quality which you saw coming, due to which you mentioned that, okay, you are very tight on the retail front. How much of it is due to that, or is it all, or does it also have a link to the broader economic growth slowing down to multi-quarter lows there? And as the economic growth probably remains softer and does not really go up, so how much of a leeway does the bank have to push the pedal on the loan growth front?
See, there is no one particular number that tells you that how much of the premonition of any credit quality in the industry that we see, so thereby pull down. So it's part of the credit process in terms of how they evaluate, how they read the market, and so thereby calibrate at the back end in terms of what comes through the door, the quality that is acceptable, and the customers that are acceptable. So that's no one particular, I can't say X percent is because we tighten. But I can tell you, you will be able to allude to certain things, but I can't tell you exactly the number. If you look at FY23, unsecured business, unsecured loans, we grew 19% year on year. It said we wanted to tighten, we tightened it a lot. 1 year roll forward, that particular book year-on-year growth came to 10%. Slowed it down. And then now it's running between 9 and 10% or so. And so if you see, there is no one particular percentage I can give, but it's a mix of so many things that go. And there is no one target that we have, saying that this is the target at which we need, because we cannot target when we are on quality origination. It all depends on what comes through the door and what is acceptable.
Thank you very much. Ashish, may I request to come back for a follow-up question?
Thank you.
Thank you very much. Next question is from the line of Manojit Saha from Business Standard. Please go ahead.
Hi, good evening. Just one clarification. You said 20,000 crore loans were sold or securitized during the quarter. And what was the 9-month period number?
45,000 crore.
35,000 crore. I missed that. Any particular number you are putting out as guidance for loan growth and deposit growth for FY26? You have said that loan growth for FY25 loan growth is below industry. FY26 loan growth will be at par with industry. But any particular number on loan growth or deposit growth, and also whether you want to grow deposits more than the loans in going forward in the coming quarters.
So there is no one particular number that we put out as an outlook or a goal or anything, because it is in relation to how the industry, how the market, and the available funding and so on. So accordingly it can get calibrated. As far as the deposit growth is concerned, yes, there is no kind of a calibration on the deposit growth. We want to grow as fast and as much with the right customer base, because it's not just about getting the deposits, but it's also working with that particular deposit customer for multiple products in times to come. So we have acquired, like I told you, 0.9 million liability relationships in this recent time period. Last year was about 9 million liability relationships. So we continue to add and deepen those relationships. So certainly the endeavor is the deposit rate of growth will be far faster than the loan rate of growth. And we continue to gain market share on the deposits irrespective of any of these in the recent time period or in a year or 3 year time period. You will see that we have gained market share, one of the highest in the industry.
Okay, thank you.
Thank you. Next question is from Madam Company Karthik from Money Control. Please go ahead.
Hi, good evening, Mr. Srinivasan. I have a couple of questions. I'm going to stay put on the loan growth. When HDFC Limited as a standalone entity was there, mortgages book grew comfortably in double digits. One would think that once it comes to the bank with cost of funds also much cheaper, it should grow at a better pace. Quarter after quarter, we're seeing that the growth pace is coming down. I understand that largely you're basing your growth based on the rate of deposit growth that you're able to garner in a particular quarter or over a period of time. Is this a sustainable practice, you think? The philosophy that the bank has now adopted to let go of growth a bit in order to ensure that the deposit base is strengthened. Do you think over a medium term you would be able to come back with a bang on the lending business with this approach, sir?
A very good point. Two aspects. The second aspect first, would you be able to come back on the lending? We are there lending today. There's no space that is vacated, except that we are very circumspect in credit selection. And we are very circumspect in appropriate pricing. These are the two determinants through which the scaling factor happens, right? We will not, under any circumstances, we will not relent on the credit quality, and pricing is an important determinant. So keep that in mind, and that is how historically we have done and grown market share. I'm confident of doing the same to get the incremental market share. Now coming back to your other question on the mortgages as such, right? We've grown mortgages at about 10% or thereabouts year on year. There are two aspects to this mortgage. One, from a distribution reach, we got more than 80% of the branches in the last 6 months or so have been very active to get at least one mortgage. So that means we are broad basing our offering of mortgages through all our branches, right? Most of the branches are big good in terms of getting. So the reach is made, and it's a question of customer and appropriate pricing. So that is one. The second aspect of this mortgage is the price. If you look at our mortgage offering, we have it at about 8.8, 8.9% thereabouts on the mortgage. Currently, the inhibiting factor that we see is the competition, particularly competition from the public sector banks, where you will be able to see fairly advertised mortgage rates of anywhere between 8.15 to 8. So those are the kind of rates at which some of them compete. We do not want to compete for the sake of volumes, for the sake of getting market share, to go down that path. We have held on to our rate, and that's the kind of, we will provide superior service, we will provide multiple products and engagement with the customer. Today, little more than 95% of any new to bank mortgage customers, we instantly open savings account. Liability accounts are opened instantly and funded at least 35,000 rupees, 1 to 2 months installment. So our approach is not to just get a mortgage at any rate, at a reasonable rate, and provide value service and provide multiplicity of products. That's how we will approach it, and that's how we are confident of enhancing the value of the shares here.
So, the point on whether the strategy to continue growth of assets based on the liabilities growth, if you can touch upon that, I'll ask my second question, sir, please.
It is not about whether the asset growth is contingent on liability growth. It's important for an appropriate funding point of view. In the current market scenario where we see that there is a slowdown in credit growth across the industry, we are quite happy to be slower than that and get our balance sheet repositioned very well and stronger so that when the cycle turns, we are there able to grow faster than the rest. So that's how we have thought about it. So it is not about whether we don't lend, it is about the right quality and at the right price. Even today we are lending, and that's how we are growing the book.
Thank you. Anthony, may I request to come back for a follow-up?
I'm sorry, my second question was not done. That was a part of the first question. So I'll put my second question. A lot of the banks who have exposure to microfinance, they're cutting down on their lending to NDFC MFIs. At HDFC Bank, what is the practice that you're doing, sir? Are you getting cautious lending to NDFC MFIs?
We're quite confident and happy with the portfolio that we have, both our NBFC portfolio as well as our direct SLI MFI book. And there is go through a rigorous process of how we operate, and we're quite satisfied with how we are, and including the quality of the book and our relationship with all of them.
Thank you. Anthony, may I request to come back for a follow-up question?
Yeah.
Thank you. Next question is from the line of Srishti Sharma from Economic Times. Please go ahead.
Hello. Hi, sir. Good evening. So my question is on the cycle of the technology spend, given there's peak in investment phase and then there's efficiency and the monetization. I needed to understand where is HDFC currently in, and if you could help me with some numbers on how much of the OPEX has gone to IT or tech spends in the current quarter or on the year-on-year basis.
It is a very important strategic imperative, right? Not just now. I think over a period of last 2-3 years, we have articulated, our CEO has articulated to say that this is one of the important and one of the top strategic priorities is to enhance our capability on technology, enabling, analytics, data warehouse, infrastructure, network security, all of those items are important. Currently at about 10% of our expenses are dedicated towards this technology, and we do see that share growing because as and when we are able to implement and get those projects in, and we will be able to get better productivity. So that means obviate the need for increase in the number of people. We don't need to increase at the same speed. We can be at a lower speed, but better productivity of people and better kind of a customer engagement can happen. The tools will put our relationship managers and sales people in a better position to get the best product. So yes, it is a strategic imperative, and we're quite focused to spending on that.
Got it. So, but I wanted to understand if the investments are currently higher now, or like where is the cycle right now in terms of funding?
It is higher today than what it was 3 years ago. And in 3 years hence, if you ask me, which is what I alluded to without giving an outlook, it's in the trajectory of making more technology investments to robustness and people.
Sorry to interrupt you, there is a slight disturbance in the audio.
Understood.
Thank you.
Thank you. Participants, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. The next question is from the line of Anshika Kyasta from Mint. Please go ahead.
Hi, sir. Good evening. Good evening. Sir, two quick questions. First, as a part of your loan sales, I just wanted to clarify, are you only looking at home loan and car loan sales, or also other portfolios including personal loans? And my second question is, could you give an update on where you are on your PSL shortfall, especially given that loan growth has slowed down this quarter and you're seeing some amount of stress in the agri portfolio? How are you placed on the PSL target?
Okay. One, in terms of the book, yes, so far we have done mortgages and auto. I wouldn't venture to talk about future what all we will do, but certainly these two have received our attention and investor interest. So we'll continue with that, and in future whatever comes we will do. But the point here is that the objective is these kind of products, or particularly the mortgage type of product, as it grows in times to come when more home ownership increases and there is a better demand, we are able to provide that customer with a product and not necessarily hold it on the balance sheet. So that's one I want to mention product. The second question was to do with PSL. Yes. At an aggregate PSL level last year or even so far this year, at an aggregate level we meet the PSL requirement, enhanced requirements. And then there is two categories of PSL, which is the small and marginal farmer and the weaker section, which typically we are short because not enough is available in the market. Both organic, which is our primary goal, is to get it organically grown. That means we reach the customer and originate ourselves, manage the customer for better value, like the way I described about that SLI, how we do. We want to do it ourselves so we can manage it better. Where we can't, we go buy certain papers. But typically we have been short about a percentage or so in that category even in the past.
And that's the only category we've fallen short.
Well, SMF and weaker. Other than that, we have excess.
Right. Thank you.
Thank you.
Next question is from Nano Shubhana Sheikh from NDTV Profit. Please go ahead.
Hi, sir. Am I audible, sir?
Good evening. It is slightly low in tone, but please go ahead.
Sir, I wanted to specifically ask about the credit card segment. You said that you're not seeing any blip in the credit card and unsecured loan portfolio, and you're also growing it quite aggressively as compared to other peers. You're growing at about 16-17% on year. So kind of wanted your outlook on the same going forward. Is this the pace that you would continue to grow your credit card portfolio book?
So then it is what the market opportunity provides to us. That's what matters, right? There are only 100 million, slightly above 100 million cards in this country, and we have about 20% or so market share, right? So essentially, the market is nascent and has got a long runway. Second, our calibrate is not just about the card origination; it is also about the spend category. That means once the card is originated and I have a card, it doesn't mean that it could be spent anywhere and everywhere and at any amount and so on. So there is a process to monitor the customer, monitor the category of spend, the merchant at which it is being spent and the location and so on and so forth. That's how we calibrate to ensure that the spend is appropriate, and thereby we are able to manage the customer relationship. So I hope that gives you an idea. There is no one particular answer or an approach to say go get every card that's in the market and allow them to spend whatever they want to spend. No.
But is there any number that you're looking at as to how much you would want to grow your credit card portfolio book in the near future?
No one particular number.
Thank you.
Thank you. Next question is from man of Gaurav Jawalkar from ET Now. Please go ahead.
Yeah, hi sir. I hope I'm audible. So sir, if I'm not wrong, if my reading says that this quarter's incremental slippages were because of the agri loans. But at the same time, if I look at your PCR ratio, that has declined almost by 200 basis points. So I just wanted to understand your point of view as why this PCR ratio is down. Is it something that you have done consciously, and how do you see this number? Thank you.
Very good. This is how it works out, which is as the agriculture comes into an NPA, early buckets, it's in the first buckets of delinquency, it calls for provision. We know that agri is a good, there is a farm behind it, and there is a cash flow on the crops that is behind it. Provisioning is lower there. So if you look at the PCR excluding agri, it's at 71%. So it is again determined through the agri, and it's a seasonal flow that has come in. And when the flow bucket, the provisions are low.
Okay, sir. Thank you, sir.
Thank you. Next question is from the line of Piyush Shukla from the Indo Business Line. Please go ahead. Piyush, may I request to unmute your line and go ahead with your question, please?
Yeah, sorry. Sir, I just wanted to understand, the former governor's, very aspirational projects on ULI and CBDC. I understand you won't be able to give volumes exactly what we are seeing, but are we seeing traction picking up? Because the aim for CBDC was 1 million transactions a day. What we see in reports is it's nowhere near. So both on ULI and on CBDC, if you could help us understand if the usage is picking up, if there is any significant growth there.
We are in it, and we have actively embraced it, and profit. I have a volume to talk.
Sir, sorry to interrupt you. We are losing your audio.
It is an important initiative. We are in the middle of that.
Any growth, sir? What is the adoption?
Particular number I have, I guess there will be some publication that will.
Hello, Piyush. Are you audible? Can you hear us?
Yeah, I'm done. Thank you.
Thank you. Next question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi. Sir, just a quick question around the PSL ratio as far as your balance sheet is concerned. So last year there was a higher shortfall is what I understand by looking at the initial numbers. But this fiscal, do you think you will meet your requirements internally, or do you think you would have to end up going to the market?
See, our goal always is to ensure that we organically meet our requirements, which means originate as much as possible and meet the requirements. That is the going in position that we always have. In terms of where we end up at the end, that again depends on what's available in the market, which I won't know now. Typically, we have fallen short by a percentage or so. That includes last year.
Okay. Fair enough, sir. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, we have come to the end of the time allotted for this call. I would now like to hand the conference over to Mr. Vaidyanathan for closing comments.
Thank you, Nirav, and thank you all the participants for joining in today. If anything more clarifications, questions or inputs you need, reach out to our investor relations Bhavin or to corporate communications Madhu and the team. We'll be happy. Thank you. Have a great evening. Bye-bye.
Thank you very much. On behalf of HDFC Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.